This is the Alhambra Investments Weekly Market Pulse with CEO Joe Calhoun. And Joe, I have to ask you, Jerome Powell has just been so intent on hike, hike, hike. Let's get inflation under control. And then there was this headline over the weekend: Fed set to raise rates by 3/4 of a point and debate the size of future hikes. Is the Fed changing its stance?
No, I don't think they are actually. I think they just got a little they got a little panicked, I think, that rates were going up so fast in the market, not, that they're raising them necessarily. Yes. But I mean, I think that there were some things starting to look liquidity looked like it was becoming a problem, put it that way, because the Treasury market was moving kind of in big leaps and bounds. And even the Fed doesn't want to see that. So, I think it was just something to calm the markets down. We'll see how it goes. I mean, look, we've got a lot of data coming out this week, and we'll see. Look, the Fed is going to have to see some improvement in inflation for them to back off. But I think there is a consensus developing at the FOMC that they need to at least slow down and see what they've done already, what the impact is. So whether that's enough to sway Jerome Powell or not, I don't know. He seems very intent on hiking this, until he sees the whites of its eyes, so to speak, when it comes to inflation. But we'll see. Certainly the market took it as a positive on Friday.
Well, as you mentioned just a minute ago, there's a bunch of information coming out this week. I'm going to run down the list. There's CFNAI, there's the Case-Shiller Home Price Index, building permits and new home sales, preliminary third quarter GDP, and then we'll talk about the big one on Friday. But all of that information, wow, what's it going to tell us?
Well, we're kind of in a strange place here, I think, for the stock market, because what we need for the stock market is for rates to come down. So in order for that to happen, it's kind of a bad news is good news thing, where bad economic news will pull rates down and make stocks more attractive in some strange way. We're going to get a lot of information about the economy this week. It's kind of interesting. We got the CFNAI this morning, was a 0.1. Look, that has been saying for the last few months that we're growing at trend. And if you look at the third quarter GDP, at the Atlanta GDP now, it's at 2.9. That's probably a little high. We're going to get a number on Thursday. It's probably going to be around 2. That is on trend. And so CFNAI is telling us exactly what we expected. I think the big number is going to be on Friday with personal income and spending and the PCE deflator. That is supposedly the Fed's preferred inflation measure, is the PCE price index. I will point out that it has come in hotter than expected the majority of the time, going back quite a few years. So it seems to be one that the forecasters don't have a good handle on. But everybody knows that too. So, we'll see if that matters. But you're going to get just a ton of information. I mean, I think the things that are obvious we're going to know. I mean, some of the housing data is going to be weak. We know that. We're going to get some inflation data that's probably going to. So it's not going to be awful, put it that way. But is it going to be good enough to actually change the narrative around what the Fed's going to do? I kind of have my doubts.
Well, with all this information coming in, there's going to be inflation information built into that. Yeah, and just in the general public, I mean, there's all this worry over inflation and are we going to go to recession? What's going to happen? But corporate earnings are looking pretty good so far. What do you see in that?
Well, this is something I've done some research on. I think it's interesting. And people have this idea that earnings estimates have to come down a lot. And if you look at history, you go back to previous inflationary periods, earnings tend to do pretty well in these inflationary environments because revenue goes up. And to the extent they can pass through the cost increases to their customers, to the end customer, then their margins stay okay. Now, look, margins have come in some. They're still around, net operating margins are still around 12%. That's a pretty darn good number historically. Better than it was in 2018 as an example. It is down from the high that we set in 2021. But in general, you're going to see, if you see nominal GDP growth, which we are, obviously, we're going to see a rise in revenue. And if companies can get that to the bottom line, then we'll see how that goes. So far, look, we've only gotten maybe 100 out of the 500 companies in the S&P to report yet. Earnings reports have been better than expected in about 70. I think it was 72% of the cases. 10-year average is 73, so it's maybe a little bit below that. The 5-year average is higher than that. But that's kind of skewed because of 2021. But the bottom line is that earnings are right now looking okay. We got a long way to go, though. We also are going to start to see some of these multinationals, some of the tech companies coming in this week. We know that, look at IBM. IBM's revenue line was down about $1 billion in the last quarter because of the strength of the dollar. We know we're going to see that in some of these other tech companies and some of these other multinationals. But again, it's a known factor, so I'm not sure it really will impact things. But look, earnings throughout the 70s, if you go back and look, for instance, at the 73, 74 recession and bear market, earnings were up strongly in both of those years. It's just that, valuations were so high going into that recession, the market still got hit. Kind of a similar effect to what we're seeing today. Market was very highly valued when we went into this bear market. Earnings seem to be holding up decently. Not as good as 73, 74, by the way. I mean, look, we're talking about single-digit gains in earnings here so far. So, but look, we're not talking about a collapse in earnings either, right? Which I think is the thing that has people really worried about stock prices. And that just doesn't seem to be happening.
And there's a lot of information in your report this week that we just don't have time to cover. So for folks watching, if you want to read the entire report, and I suggest you do, here's where you can find it. So let's wrap up today. Joe, I want to talk about the inversion of the 10-year, 3-month yield curve. I mean, there are lots of curves and there are lots of inversions. The 10-3 inverted last week. If you blinked, you missed it, but that's one of the really important ones we watch.
Yeah, look, I mean, all of the research on the yield curve was done on the 10-year, 3-month curve that was done at Duke University. I forget the economist name there who did that research back in the late 80s, but that's what the research was done on. I don't know why people zero in on the 10-2 curve, but it doesn't matter. Look, there's a correlation between yield curve inversions and recession. I do not believe, by the way, that there's a causation. I'm not sure exactly why an inverted yield curve precedes recession, except to say that it generally reflects tightening monetary policy. So the 10-year, 3-month curve did invert very briefly. We closed the week at a positive 12 basis points. We've seen this before. We inverted in 2006, the 10-year, 3-month for about a cup of coffee, just like we did this time. And then we re-inverted later on. Generally that first inversion, well, let me put it differently. Inversion of the 10-year, 3-month curve does precede recession. I don't think we've ever had an inversion of that curve and not gotten a recession. But the key here is lead time and also the depth of any recession you might get. Lead time average over the last 4 recessions was 12.5 months from the first inversion to the onset of recession, which would put us in recession at the end of next year. But there have been shorter ones in the past too, so you can't count on that. I don't, right now we're not in recession. How long it takes us to get there, assuming that's where we go, we'll see. We are watching a lot of things. We want to see some confirmation of that. So we want to see credit spreads widen, for instance. Credit spreads widening would be another indication that a recession, that there's risk aversion in the credit markets and that a recession is on the way. We'll see how these things go. Right now, we don't see that stress in the credit markets. Maybe it's coming, maybe it's not. I don't know. And again, we don't know anything about the depth of any potential recession. How bad would it be? I'm of the opinion it wouldn't be that bad because we have a labor shortage, because there are plenty of job openings compared to the number of people available to take them. So you would have to really have a really bad recession to knock employment down. And the other thing is that individuals or household balance sheets are in great shape. Households still have plenty of cash on hand to spend if they want to do it. We saw that from Brian Moynihan's interview last week on CNBC, where he said that, spending year over year is looking like up 10% right now. And that's down from the spring, but it's still pretty darn good, and it seems to have stabilized. He also said, by the way, that people's balances, their account balances, are stable. They're not going down. So people do have the ability to spend. And I think that may mitigate any recession that we get. It just depends. I mean, we don't know what shock might come along to make it worse, but right now I would tend to think it would be pretty mild, but look, we're not in a job of predicting the future. So we're going to take it as it comes. We kind of now have to be on recession watch because of this inversion, even if it was brief. But in general, I think because it was brief, I think we got to be looking quite a ways out right now.